morning, everyone. It is Thursday, January 29th, 2026. This is our first video this year. It's been a while. But we saw the federal funds rate remain unchanged yesterday, and that didn't shock the market at all yet. But I'm curious to see what that does, and obviously we need to talk about gold and silver and the U.S. dollar and what in the world is going on. And my friend Jay this morning said, make it make sense. So I am. And I am coming to the realization that I was blind to something that Ron Paul was blind to. I've been listening to him since 2008, and I realize now the error of my ways and the error of his ways. And I have discovered a gentleman who I highly respect, who has the greatest understanding of the stock market of all time. He has figured out the key that unlocks infinite wealth, and I think it's purely amazing, and I think it is timeless, and I think no matter what is happening in the world, regardless of the federal funds rate, regardless of who is the Fed chair, regardless of what gold is doing, his stuff works because it's how the world works. And it's called ICT Inner Circle Trader is the guy's name. And I invite you to look him up and take him very seriously, because I wish I would have known about this years ago or decades ago. But nothing is what it seems, and everything is technical. Nothing is fundamental. And especially since Bernanke took over, we have seen nothing is fundamental. Everything is technical. The question now is, will there be a fundamental shift back to Greenspan economics? And so I've got pulled up here the poly market or whatever Kalshi prediction, who the Fed chair will be and why this is important to you. Right now, we have seen a shift in what's going on with who Trump will nominate as the next Fed chair. Currently, we have Jerome Powell, J. Powell, who has been making America billions since COVID, and his response. And just a quick TLDR, Jerome Powell believes that printing money and buying stocks to pump up the market is beneficial, and it has been. And we never, people who follow Ron Paul, I have since 2008, were wrong. We're wrong, and Robert Kiyosaki was wrong. Not that they were wrong, I guess, in that sense, because what they have to say is completely right, but our response to what we thought was going to happen was unfounded in the current Federal Reserve monetary policy. And so anyone with a 401k and all that stuff, that's great for you. I'm curious to see who will be picked here for the Fed chair, because that will shift. That will either shift or continue what is going on. So this is why this is so important to look at. So gold has broken out of this cup and handle and just absolutely took off. And we want to know why. Well, Jerome Powell's term is coming up in May, and so Trump will nominate a new Fed chair. And if we look back at the stock market here, we can see when there were shifts in policy. Let me put a indicator on here. We don't need volume. I want to put, you can tell that I did not map out this video here, did I? Moving average. So let's take this, a 4-quarter, remember we're on a quarterly chart, a 3-month chart. We're going to go with length of 4 quarters. So the this blue line here, which you can kind of see, this blue line represents the average of the last 4 quarters. So as you can see, since forever ago, 94, every time other than crashes, every time the market gets below, so this was the plan here in the 2008 crash. Every time a quarter closes below the 4-quarter average, the Federal Reserve will buy the stock market to get back above that average. This has been the monetary policy since 2008. That every time the market closes below this line, the Federal Reserve prints money and pumps into the stock market, buys equities, literally buys the stock market back up. So we have, obviously 2008, every single time it dropped below, they added money into the stock market. Down here, when Trump was in office, they continued because he reappointed Powell, and Powell did the same thing. In 2020, Jerome Powell said, we're going to pause quantitative easing. And we saw for the first time 2 consecutive quarters close below the line. So what happened again? They resumed quantitative easing, and they pushed it back above this line. So this, for long-term investors, has been the mode that the Federal Reserve works in since the 2008 crash, to prevent another 2008 crash, right? Until 2020, when Powell said, hold on, we're going to take a pause here. We don't want inflation to get too crazy, right? And then they resumed, and now we are in this again. Now, as of right now in this quarter, we are extended away from. So the expectation would be to come back down to this line. So you could expect in the next quarter, which is consistent with the second year of a president's term, we would have a small correction. And that's beside the point. That's not what I'm here to talk about today. What I'm here to talk about is, depending on who Trump nominates as Fed chair, will decide if this is going to remain the financial policies of the Federal Reserve or not. And why is this important? If you go back to Greenspan, I encourage you all to read this book here, Greenspan's Fed in the American Boom. Depending on what the next Fed does, will decide if Ron Paul and Robert Kiyosaki were correct all along. And what we're starting to see, a preview of this, is that they were, But the reason it didn't work is because of the Fed's policy. And if we get someone who is an Alan Greenspan, like Rick here, see, we have Kevin Warsh, Christopher Waller, Kevin Hassett, Scott Besson. They're all the same policy, the same idea, that the expectation is the economy will grow more than inflation will grow, and in the long term, the market goes up. Everything goes up in value more than inflation goes up. But what the markets are telling us is that someone is going to be appointed the Federal Reserve Chair who doesn't believe that, who believes that inflation is out of control, and they are going to make policy decisions not based on 2008 to today's policies, but back to the Greenspan era. And the best way to do this is to look at the dollar index, DXY. And we can take a look at, so this is the dollar index here. And you can see, so when it's, to be simple, when it's red, when it's down, that means the value of your dollar is expected to be less than when they print it. That your buying power with that dollar is not actually worth $1 anymore, right? And the reason this isn't just absolutely dumping to the ground in 2008 is because the expectation with the Fed, if you look, you can see we were kind of in a downtrend here, and then in 2008 we moved up to an uptrend. That even though inflation was rising, the value of the dollar compared to the rest of the world, compared to oil, compared to the future, it is better to have a US dollar than not. And that's been consistent since 2008. The faith in the US dollar has been in an uptrend since 2008. Of course, when everybody thought the world was ending, that would make people move out of the stock market and into the dollar. But what's interesting is it didn't continue to roll over. So we have Carter administration, Reagan administration, Reagan crash. Then we have Greenspan era. And then we see this radical shift where in 2008, Ron Paul was screaming, the world's going to end, everybody needs to buy gold. And at the time, in 2008, gold was in an uptrend. And it did go up, right? But ultimately, it came down and really had just chopped here from 2012 till COVID, when people started being fearful again and they bought the dollar. But as you can see, there's a difference between this, Ron Paul's idea that gold would be worth more than the dollar, that the dollar would go down. There's a difference between that and this radical move up. And this radical move up is a sign of an end of an era to me. It's a sign that Bernanke policy is coming to an end, and that is verified with this uptrend being broken this quarter in the dollar. That the value of the dollar is going to start coming down. If the value of the dollar comes down, that doesn't necessarily mean the stock market crashes, because it takes more dollars to buy the same stock. Like, let's say you had a share of Apple at $200 and the value of your dollar goes down, that makes the value of that stock in dollars go up. You have to use more dollars to buy the same thing. For example, bread, right? What bread used to cost a dollar a loaf a couple of years ago now costs $3 today. It takes more of your dollars to buy that bread. That's the same philosophy with stocks. So ultimately, somebody knows something here about who the next Fed chair is going to be. But if we look at these people here, Rick is leading but coming down. We also have Judy Shelton down here, who is also a gold person. Rick is a gold and bond person. And it seems like these people are not going to be elected. That the kind of like the Wizard of Oz, the guy behind the curtain, that's what this has been since 2008. There's been something going on that doesn't make sense. The market shouldn't be this high, right? So, what do we do now? If we look at what stocks are doing currently, we can go back to my original idea here of ICT. Well, let me reset this. The fundamental underlying theory behind ICT is that the market, regardless of circumstances, always is looking for equilibrium. That it is always looking to balance itself. So, if we look at, for example, I wish I could find the best example here. Let's just go to 12. Just go to 1 year chart. No. All right, so this is a 1 year chart. That means each bar is 1 year, right? If the market is always trying to find equilibrium, then we can find a place where there's an equal move up and there's an equal move down. And then what he wants to look for is places of imbalance. Imbalance is where you only have a move up, and as you can tell over here, there is no equal move down. So when you have just a move up, this is called a fair value gap. And what you do is you would look at where the gap would be. Let me get my little measuring tool here. But you'd have a move from, let's say, this candle to this candle. And we are going to extend right. Make it really visible. So as you can see, there's no down move in this area. It's only up, right? So that is a fair value gap. This is taking me a while, but I encourage you to look this up here. So that is a fair value gap where there is no red candle going down through that part, right? From this candle to this candle, there is also a fair value gap. And now from this candle to this candle, let's make it different color here. This is considered a fair value area because you have an equal move up and an equal move down, an equal move up, and an equal move down. In his theory, it should not break this area ever again because it was fair to everyone. It was fair to the buyers and fair to the sellers. Why 2008 bounced here is very interesting. So as you can see, this was at one time a fair value gap from this candle to this candle. So it went up, it came back down into this area. That made it a fair value. So let's mark off the bottom of this. And hopefully you can see that. So from here to here to here is fair value area. This means an equal number of buyers, equal number of sellers. So at this point, if you were at this point in 2002, you would ask yourself where, because the market always wants to find equilibrium or it wants to find liquidity. You would ask yourself, where is an area of unequal value? The area of unequal value in this case would be above this candle because this part is equal. So if it starts to go up, then you know the target is going to be above this fair value area. So what did they do? They ran above this fair value area. See how that little wick comes above? Now they found out when they get there that there are still sellers there. So where do they run to find another place of liquidity or another place of unfair value? It would be under this candle, right? So they ran from here, 2008 crash, ran underneath this candle. Now, what's interesting is because this would have been a fair value gap, right? Let's make this one blue here. Or no, that's good. That's easy to see. Because this candle has already been touched once, because this candle has already been here once, that means this cannot be the reference point of where the next move up would come from because this has already been used. So where do they have to go? They have to go to the next one. So what do? They come down to this candle. This candle is next in line, the next fair value gap in line. And if you want to say that everything is random, I want to see where this lands. This is a percent retracement. So let's go from here to here, and we have it'd be 1, 75%, 50%, 25%, and 0. Where did this bounce? From the 50% mark. It literally went 50% of this candle and bounced. So the 2008 crash came down, took out this low, couldn't use this candle to bounce because it's already been used once. So it had to go to the next candle. It came down to exactly 50% of the next candle and bounced. And when it bounced off of that fair value gap, where did it go? It went back to an area of unequal value, which would be above this. Okay, let's keep moving. So now we have from this point to this point would be considered a fair value gap. We have this area is a fair value area. We'll keep fair value areas yellow. What did it do? It dipped below this fair value area. It found buyers, and so it ran back up to the next unfair value, which would be above this fair value area. Now it's starting to get crazy, right? Now we have a fair value gap from here to here. As you can see, it respected that when it bounced on this candle. But what's even crazier, let's see what the distance between here and here is. This fair value gap. What do you know? It bounced at the, let me make this a little clearer here. Take off 25 and 75 here. It bounced at the 50% mark of the gap between this candle and this candle. Now we have a completely fair value area from that point all the way to here is now fair value. Equal number of buyers, equal number of sellers. Actually, wait a minute, let me correct this. It'd be to there, right? Equal number of buyers, equal number of sellers. And then again with this push up, equal number of buyers. And then we create a fair value gap again, which is green. And then we have a fair value area, equal number of buyers and sellers. And that's my dog wants out. And now we have this scenario here. We have an equal number of buyers and sellers there. We have an equal number of buyers and sellers here. Actually right there. That's equal. And now we are creating a fair value gap from here to this candle is unclosed. This is 2026. This is 2025. This is 2026. That is a candle. So what do we do with all this information? Now that we know that the market is completely balanced, right? Because from here to there was respected. Everything is completely balanced. The only place that is imbalance is this candle here, because it bounced at the 50% mark. So the question is, are we going to, in 2026, create a new fair value gap that will push higher and it will just continue going on, and then in 2027 we can have another discussion if we bounce here? Or do we run into the scenario where 2026 candle closes below this gap and completes a fair value area? So I'm going to put a line on here. This is in SPY, which is like 1/10 the price of S&P 500. And I'm going to put a note on here that says, check back 2027. If we closed a candle below this. Watch for a bearish market to head toward 2020 low. And I'm going to check back on January 2027 and see where we're at. But for long-term investment, if SPY stays above 600, basically, then you can expect that this monetary policy is going to revert. Someone is going to be selected out of this group, and the market will just continue going up. That this will be an area, now it might chop around for a year or two, just like it did in 2020. But ultimately, we are in a bullish market structure. There is no reason to come down yet. But if Rick or Judy are selected, then we need to consider the real possibility that this unfair value, the low of 2020 COVID crash, needs to be reswept in the same way that the 2000 dot-com bubble was swept by the 2008 market crash, right? 2000 dot-com came in here. When it did start to fall, they couldn't use this as support anymore, so they had to go below it. In this scenario, we have this candle has already been taken because this has been tested by this red candle's wick right here. This is already taken, so it cannot bounce here. So if it does not bounce at 600, there is only one place to go, and it is down here at COVID lows. The entire stock market will go below the crash of 2008. The only way this will happen is if Trump nominates somebody who is the same train of thought as Greenspan. That's why I'm saying you need to understand this, you need to understand this, you need to watch, because if they pick anybody who is like Jerome Powell of these people, then likely this area will hold. And we will see rapid expansion higher when everybody thinks the world is ending and and to short the market. That's not going to be the case. And this will be enough support to push for the next push higher. Man, I need to let my dog out. Anyway. Rapid expansion higher, depending on who is picked here, what their policy is. And then a rapid run lower if 600 is broken and somebody like Alan Greenspan is chosen for the Fed. Rapid expansion lower to take out the low of 2020. And all of the wealth that has been built over the last 5 or 6 years will just be gone. Thanks for coming to my TED Talk. Please watch who Trump nominates as the Fed chair, and as soon as they are selected, I will make another video. I gotta let my dog out. Have a nice day. Thanks.